For the first time in history, the money sitting in index funds is larger than the money run by every active stock picker combined. By late 2025, passive US funds held about $19 trillion against roughly $16 trillion for active. Here is the strange part. Most of that passive money does not care what a stock is worth. It buys because a company is in the index at whatever price the market quotes. That is a new kind of buyer, and it now sets the tone for the whole market. Let's open up the machine. Why does this matter to you, even if you never buy an index fund? Because of how these funds decide what to own. An active manager asks a question: is this stock cheap or expensive? A passive index fund asks nothing. It simply mirrors the index, holding each company in proportion to its market value. Money comes in, it buys. Money goes out, it sells. No view on price. When that kind of buyer becomes the marginal buyer, the one setting the last traded price, the market starts to move on flows, on money in and money out, rather than only on fundamentals. That changes what a rising or falling market is actually telling you. Let's back up and see how we got here. For decades, active managers ran the market, but a steady tide moved money toward low-cost index funds, year after year. Because most active funds struggled to beat their benchmark after fees. The milestone arrived in 2024, when total assets in US passive funds passed active for the first time ever. The gap then kept widening into 2025. Now, most index funds are cap-weighted. That means the bigger a company, the larger its slot in the index, and the more of every new dollar it receives. So a simple question opens the whole mechanism. When a flood of money buys the whole index by size, where does that money actually land? Here is the machine. Start with $1 flowing into a broad index fund. Step 1. It is split across every company by market cap weight, so the largest names get the largest share automatically. Step 2. And this is the part most people miss: markets are inelastic. Research on the inelastic markets hypothesis finds that $1 invested in equities can raise the total value of the market by several dollars, because there are not enough willing sellers to absorb the flow without a much higher price. Step 3. Because the biggest companies soak up most of each inflow, their prices are pushed up the most, which makes them an even bigger slice of the index. Step 4. The next dollar then buys even more of them. The weighting feeds on itself. Nobody chose to concentrate the market. The mechanical rule did it for them. This is not theory. Look at the result. The 10 largest companies in the S&P 500 now make up somewhere around 37 to 40% of the entire index, near the most concentrated level on record. A decade ago, that top 10 share was closer to 20%. So it has roughly doubled. And here's the tell. In 2025, those top 10 names carried about 41% of the index's weight, but were expected to generate only about 32% of its earnings. Weight ran ahead of profits. When money buys by size instead of by value, price and fundamentals can drift apart, and a single earnings miss in one giant name can swing the whole index. The people most exposed are the millions who think an index fund is automatically diversified. So here's the lens to keep. Passive investing was built to be humble. Own everything cheaply and stop trying to outguess the market. But at scale, that humility became a force. A vast, price-insensitive bid now flows into the market every payday, buying companies by size rather than by worth, and quietly concentrating money into the largest names. It is not a bubble signal, and it is not a crash signal. It is a structural feature of how modern markets are wired. Active managers still set relative prices at the edges, but the tide underneath is increasingly automatic. So the next time you hear the market hit a record, ask a sharper question: was that price discovery, or was that just the autopilot buying by size again? This channel explains how markets work. It is educational, not financial advice.